So good afternoon, everyone, and welcome to this AFME-hosted webinar for European Retirement Week. My name is Jacqueline Mills, and I'm the Head of Advocacy for AFME. I think people are still joining us, so I suggest we give it 1 or 2 minutes before we kick off. Just wait for a little while. Okay, good afternoon, everybody. Let's kick off, and I hope that we'll be joined by a few more attendees as we get started. But let me start by setting the scene for today. We're very glad to be taking part as AFME in in this year's European Retirement Week, where the aim is to raise awareness of the EU's pension challenge and to bring together a wide range of stakeholders for discussion on how to ensure European citizens' financial well-being for their retirement. The focus of this afternoon's webinar is to examine the ways in which wholesale markets interact with pensions and investments for retirement, and to highlight some of the key policy debates to highlight how some of the key policy debates in wholesale markets are of relevance for anyone looking to save for retirement. We'll try to boil this down into what efficient markets mean and why they matter. I'm delighted to be joined in this discussion by representatives of wholesale market participants from both the buy and sell side. First of all, Matti Lepala, the CEO of Pensions Europe. Hi, Matti. Thanks for being with us.
Hello, Jacqueline. Very glad to be here.
Susan Yavari, who's a Senior Regulatory Policy Advisor in the Capital Markets Division of EFAMA. Hi, Susan. Thanks for being here.
Hi, Jackie. Thank you so much for having me.
And my colleague, Pablo Portugal, who's a Managing Director in AFME's advocacy team and who leads on our CMU work. Hi, Pablo.
Hi, good afternoon.
To set the scene for our debate today, I'd like to start by showing a short video clip which explains how pension funds and their asset managers interact with markets and what the role of banks within the market is in terms of providing liquidity to these investors. Sarah, can we please show the clip?
Countries across Europe are facing a demographic challenge that will put pressure on public budgets and state pension systems. This means that European citizens increasingly need to invest in long-term products to get higher sustainable returns and a suitable complementary income for their retirement. The vast majority of citizens access their financial markets via collective investment schemes, such as mutual funds and pension funds. These pool and invest individual savings in the economy. Many pension funds use external asset managers to manage these investments. Wholesale markets cater for these and other types of institutional investors, as well as large companies and public sector organizations seeking to obtain financing. Pension funds and their asset managers rely on a healthy environment for buying and selling the instruments they invest in, especially as their prudent investment policies can require them to exit an investment or reduce their holdings when market conditions change. Well-functioning, liquid wholesale markets are a fundamental enabler for pension funds because they'll typically need to buy or sell a large number of shares or bonds in their portfolios. These transactions need to be executed with the best cost efficiencies to ensure the highest ultimate returns for the individual investors they represent.
Stock market is now down.
Inefficient markets and undue restrictions on trading modalities can increase the cost for pension funds, affect the performance of investment products and the fees incurred, therefore leaving less returns for savers and less capital available for investments in the economy. What role do banks play in this ecosystem? banks play an essential role in making markets, where liquidity is difficult to find. They are crucial shock absorbers, enabling pension funds to enter or exit large investment positions when they need, particularly in many cases when the other side of the trade is not immediately available. It is important that the European regulatory framework continues to support well-functioning, diverse and competitive markets, and the role of banks in providing essential services to institutional investors and other clients. As the voice of Europe's wholesale markets, AFME works to promote deep and liquid markets which can serve the needs of European savers and help to maximise the value of our pensions. Find out more about our views on current regulatory debates at www.afme.eu.
I hope that you enjoyed that, and that clip gave you a good flavor of how pension funds and their asset managers interact with markets and the role that banks can play there. But let's turn to our panel discussion to develop and explore some of these themes in more detail. I'd like to start, Matti, with you, if I may. And before asking you why an efficient secondary market ecosystem is important for your members, I wanted to really start sort of with the fundamentals and ask you to kick us off by giving us an overview of the main challenges that you and your members face in delivering returns for your investors today in the current climate.
Certainly. Thanks, Jacqueline. Obviously, the present situation with inflation and interest rates is challenging for all pensions, whether it's pay-as-you-go public pensions or funded pensions, whether it's defined benefit or defined contributions. So it's a challenge for all. And of course, for funded pensions, the challenge is to how to generate real returns. And that is not easy in this situation, but it was not easy in the low interest rate environment. And then many pension funds, in order to get better returns than from very low yielding government bonds, change their asset allocation more into private assets to different types of alternatives. So that we could see clearly, and that was very, very good. Some years excellent, and of course very much assisted by the monetary policy, the quantitative easing, where money was pushed to the markets, and much of it had an impact on the valuations of private assets. And of course now the situation is very different. Monetary policy is tightening, but for how long, that is uncertain, because at the same time I think there will be surprisingly soon need again for central banks to act. There's many uncertainties. So I think there are many challenges, very many questions that are open, and then pension funds need to take all of that into consideration. But of course, inflation and interest rates are now the big issues. But with the interest rates, of course, the other side of the coin is the fact that if pension funds, like in some countries like the Netherlands, use risk-free interest rates as the discount rate, then the value of the liabilities has gone down when the interest rates have gone up. And even though this year, 2022, the value of the assets has decreased tremendously in many cases, the value of the liabilities has decreased even more. So the funding levels of pension funds in these countries look much better, and they can now give out benefits that are they were not able to give out indexation and other benefits when they had excellent returns. Now they're losing money, but they can give out better benefits. So this is difficult to explain, but the underlying issue is, of course, that you have to invest your assets and you have to get real returns, and there are new challenges and new uncertainties is going forward. So challenging times for pension funds.
Thanks, Matti. So yeah, a very, very challenging economic environment for the moment. Nevertheless, with some perhaps surprising exceptions, which are perhaps some bright spots, but it is a challenge to achieve those returns for pensioners. how do you see efficient secondary markets helping you and your members conduct their activities in general, and perhaps particularly navigating these current challenging times? What is it? What do efficient markets mean for you, and what do they do for pension funds?
Yeah, I mean, as I think the good video that you showed ended with the notion of deep and liquid markets. Of course, pension funds as active investors in these markets, our members of the members of Pensions Europe, they invest 7 trillion euros, and much of it in European markets, of course, diversified globally, but very much in the European markets. And deep markets, liquid markets are important for many reasons, but of course, especially when you have to sell. Pension funds are, as we say, natural long-term investors, patient capital, and they can keep more than many others illiquid assets and also benefit from that with the illiquidity premium. And at the same time, in this situation, liquidity concerns have grown, and pension funds have looked at their limits in private assets, and some are going more to government bonds and listed equity. So those are, I mean, pension funds actively need to trade in these markets, and efficient markets, and liquidity issues, especially at this moment, are increasingly important. And one aspect is, of course, the collateral management issue. Pension funds use derivatives, not that much, only 1 to 7%, I think it was, of the assets are in derivatives. So there are many countries that hardly use derivatives, but some, like the Netherlands, which is the biggest pension fund country in Europe, they do use derivatives, and then they hedge their liabilities, interest rate, and currency risks, and of course then you have the question of meeting margin requirements, and there they need liquidity and efficient markets when they need to sell, meaning that they need to transform their liquid assets like bonds into cash if they need cash as a variation margin. That's a specific issue which is now relevant in this market situation.
Indeed, and maybe we can come back to that, because as I understand, there'll be some changes next year to the clearing requirements for pension funds. So maybe we can
Indeed.
come back to that in a second round to understand how you and your members are affected by that. But okay, that was thank you very much. That was very very clear. And if I sort of try and summarize it, I think one of the main points that you stressed is that pension funds need to have another side to the trade when they need to change the allocation of their portfolios, for example. So that's why liquidity is important, of course.
Yeah, and if I may add,
Sure.
of course, we don't have just one European market. We have, different parts of the market and in different developments
Different assets, yeah.
and aspects, and of course that poses challenges. Pension funds are still often regionally or locally biased. So it's not just Europe as a whole, it's also how the regional markets where they need to trade and where they need liquidity, that those are important issues. So we need overall development of European capital markets, but we also need development of many of the local markets.
Yeah, no, absolutely. Thanks for that. Let me turn to Susan from IFAMA now. And Susan, the asset managers that you represent, they often work also on behalf of pension funds. Why is liquidity so important for your members?
So thanks, Jackie. I think if we focus this part of the discussion just on liquidity, for us as buy-side participants, I'd look at two aspects. One is the pools of liquidity, so the existing liquidity. Is it there? Is it a deep pool of liquidity? And the second aspect of liquidity is, of course, if it's accessible and if there's data to show that it's there. So I think there's two dimensions to that when we consider liquidity, and I have several sort of points to bring around that, but fundamentally we should think about is there an existing pool of liquidity, and am I able to read it? Am I aware of it as an investor? That's going to drive investor choice, investor behavior, as I think Matti was also saying from a pension fund perspective. So in terms of how we interact with liquidity and sort of, the current state of capital markets today, I think one thing we like to preserve and perhaps improve is, of course, the diversity and competition in the trading market. And I think with MiFID II reforms, we have, a healthy healthy choices in terms of our counterparties. We have the trading venues, but we also have the ability to execute with SIs and, at times also on dark pools, which I'll come to in a second. But preserving that diversity, I think, is very important. And I think part of that lesson and part of the, to sort of support this point, of course, is around some of the market stresses that we've lived through recently, right? So whether it was with COVID, but also with Ukraine, and also even with more recently on the gilts, on the UK gilts, again, when there is a significant shock and there's investors looking to change their positions, you do want to have a diversity of counterparties that you can interact with. And I think particularly on the traditional market maker side, our observation, our experience has been that in these periods of market stress, the balance sheet constraints and some of these requirements that came in through, various reforms of the Bank Capital Requirements Directive perhaps have been a little bit sort of too onerous and have restrained the ability of market makers to be there and to provide liquidity. So that's one aspect. And I think the other, I know probably in the second segment, we'll look more into actual regulation. But again, from buy side perspective, it's important that one of the things that we do is trade in size, which is a kind of, a term to describe executing large trades. And when we're executing large trades, as you can imagine, the huge orders that we move in the market, information leakage is a major risk. The minute you have an order out in the market, and if it's on a central limit order book, so it's in a lit exchange for all other investors to see, you've given up a huge amount of information, and that price can move against you quite quickly. So you don't want to be, suffer from information leakage, which is why it's important to have that diversity of options. And I would put into that basket also the ability at times when necessary to trade differently and to have limited pre-trade transparency to allow some of these trades to go through with minimal information leakage. If I could continue, I think another aspect that's interesting from a buy-side perspective when looking at liquidity is our ability as as a buy side, with the fiduciary duty that we have towards our clients, towards the fund holders, is to deliver best execution outcomes to those investors. And again, to do that, we want to access the deepest pools of liquidity, know where the narrowest spreads are. And again, we need the data to support that. And I think Matti was alluding to this in his earlier comments, this is all the more difficult given that we operate in a large and fragmented market, with the EU27, multiple exchanges, just sort of the incumbent exchanges, but then many more alternative trading venues. So having that consolidated view of liquidity and price, I think is hugely critical to deliver best execution.
And do you think that would contribute to sort of helping in the situations that Matti described, where there are more regional players who perhaps might be sort of struggling finding liquidity in a more constrained, limited market? Having that consolidated view across the EU27 would be helpful in that context.
Definitely. You know what? I do think, Jackie, there's a little bit of a, I don't think it's the focus right now of any kind of policy review, but I think there's a little bit of a two-tier Europe in that, we have the more liquid established markets that, the investors interact with, and then there's kind of the more fringe markets. And again, how do we lift that and improve liquidity and build on it? Because as we know, liquidity begets liquidity. Well, as you rightly pointed out, I think there are certain segments that are overlooked. So I think some of the smaller markets are overlooked because we don't have access to the data. And I think today it's kind of more of an opt-in option, and there's costs associated with that. So perhaps we're not seeing the amount of trading that we'd like to see for those. And also another area that I'm aware that, you know, that is kind of underperforming is on the small and medium caps, right? And there has been interest, particularly post-COVID, in some of these stocks. But again, because of a lack of that consolidated view and having this fragmented landscape, investors are a little bit shy about engaging with some of the SME stocks. And then maybe a final point to close off on is, in terms of liquidity, I think it's important to place European capital markets in a global context. And I know this is important also to the policymakers who are listening to us or who are looking at some of these key files. And so how we position in terms of competitiveness, and are we doing two things? Are we preventing from EU investors, whether they be pension funds or pension funds acting through a mandate through the asset managers, so my members, are we retaining those trade flows in Europe? Are we executing in Europe? Are we investing in European securities, or is that flow going elsewhere? And we see evidence that, you know, there's a strong push to be going external. And equally, are we able to draw in global investors? You know, and I can think of one product line in terms of ETFs, which are hugely attractive to the global investor segment. How, you know, and with the UCITS wrapper with all its sort of fiscal benefits, and nevertheless, we are overlooked because we cannot showcase liquidity, because we don't have this ability to read off liquidity on a single source. So again, it makes the global investors a little jittery around that. So yeah, so there's different aspects to explore there, but I think all ones that perhaps Pablo and Matthew could identify with, I would have thought.
Absolutely, and I'll ask them to come in now and see if they want to react to you. But I think you highlighted from your perspective, what's important for liquidity and therefore efficient markets is choice about where and how to trade, and then visibility and data of where trading and liquidity actually is. And the sort of better picture is a single picture which provides an overview of what is happening across the EU. At least that's probably what is necessary when we have currently fragmented markets along national lines. Building that picture is a key solution. And maybe we can talk about in the second round of questions a little bit about the regulatory initiatives underway to try to foster initiatives such as that. Pablo, before I give you the floor for some specific questions, I don't know if Matti or indeed you would like to react on anything that Susan had said. No, Matti, not at this.
No, not really. I think I would agree what Susan said. It's very important. You know, we really depend the pension funds as investors on these issues, and of course the competitiveness of European markets is very important. As you know, pension funds, even though they are diversified, they are very much investing in different markets in Europe. So those are key issues for pension funds as investors, I would say.
I think this is going to be one of those discussions where we all violently agree with each other. And with that in mind, I should remind, or I should inform the audience that if you would like to ask our panelists questions, please do type in a question in the Q&A function, which is available at the bottom of your screen, and we'll make sure that we try and get to them. Pablo, if I turn to you now, as we saw in the video, we saw that banks act as liquidity providers to institutional investors, and that's what we've been discussing now with Matti and Susan. From your point of view, representing the sell side, what are the key ingredients for a healthy and efficient secondary market? And then maybe as a follow-up, it would be good to also hear your views on how the EU compares to other markets, as Susan started discussing as well.
Thank you, Jacqueline. I think going back to the theme of our webinar, it's very important to emphasize why efficient secondary markets and liquidity provision are so important to pension funds and asset managers, institutional investors that often manage funds on behalf of pension funds. it's important to emphasize that the cost of accessing liquidity and conducting activities in secondary markets becomes a significant factor, and it adds up over many trades that institutional investors need to conduct. So those costs are ultimately passed on to the end saver that is being served by the institutional investors, and that is reflected ultimately in what we as citizens get from our pensions or from our savings when we are deploying them with different funds. So that is why it's so crucial to have really the efficiency in wholesale markets to minimize those costs. I mean, let's say a few more words about liquidity, which Susan and Matti have already spoken about, and it's a critical concept, of course. And broadly speaking, we sort of define it as the capacity of market participants to buy or sell assets without causing major movements in their market price. So we kind of see three broad dimensions of liquidity to emphasize. One measure is the bid-ask spread, which is the difference between the price someone is willing to pay for an instrument and the price someone is willing to sell at. And this is crucial because the tighter the spreads mean that the greater the liquidity, and therefore the better pricing that investors can obtain in their transactions, and this again becomes a key indicator of the efficiency of markets. So how do we obtain tight bid-ask spreads? I think this goes back to Susan's point around the importance of diversity of choice and competition. That will generally lead to more efficient markets and therefore better pricing for investors. Another kind of dimension of liquidity is depth. A market is considered deep when there's a large flow of trades on a frequent basis with a persistent willingness by participants to trade. And large trading volumes generally indicate that a market is resilient and that there is depth in liquidity. Again, how do we achieve these kind of large trading volumes? It's important to have attractive markets for that. It's important to be able to attract investors to these markets globally, because the investors can come from anywhere and participate in the markets and therefore add to the depth. So that is another crucial dimension. And finally, breadth of liquidity, we generally interpret that as looking at how liquidity is distributed between the different asset classes and the different characteristics across markets. Clearly, equity and fixed income markets are very different. And I mean, coming to the pension fund sector, for example, as Matti was explaining, due to the long duration of their liabilities, pension funds are long-term investors, and they typically engage in very large transactions. They when they invest in a company, it's a big investment. When they divest, it's another kind of big it's another big development in the market, and therefore it's very important that they're able to do these transactions with minimum market impact. And here it's the support that banks as market makers provide is very important, because banks often act as committed liquidity providers that help pension funds execute these large transactions in the most efficient way. And for that, we need, of course, choice of execution. When it comes to bond markets, again, a pension fund, for example, may have to sell instruments if there is a downgrade in certain types of bonds, because they often have conservative investment mandates. And again, the market making function becomes crucial here, because fixed income markets, bond markets are often are always less liquid than equities. And here it's very important to have the intermediation function of a bank that will be trading on its own account and providing its balance sheet to help intermediate between buyers and sellers and help the execution of that bond transaction. So how does the EU compare to some markets? You also asked me that. in our recently published CMU key performance indicators, we looked at some sort of comparisons with the US and the UK as well. Of course, it's obvious that the EU is a more jurisdictionally fragmented market compared to these other countries. We have many more infrastructures, but there are many more countries, and that generates more frictions and barriers. When we analyzed in our KPIs report, we looked at a random set of mid-cap stocks in the EU, UK, and the US. We found that these in this random set of stocks, bid-ask spreads were much tighter in the US compared to the best performing EU countries. So clearly, countries in the EU will perform differently, but we took the most kind of the tighter spreads in some of the larger member states, and we still found that the US were generally much more efficient when it came to mid-cap shares, and we took those shares because it was easier to compare them across the jurisdictions. We found similar results in corporate bond markets, where we saw that most liquid bonds in the US tended to see many more daily trades compared to similar types in the EU. So again, it's useful to keep all these comparisons in mind, because as I was stressing earlier, the costs add up, and ultimately they're reflected in the value of our savings and our returns.
Thanks, Pablo. So if we look at the different dimensions of liquidity that you described, so what is needed for liquidity to be qualified as good, for a market to be healthy, when you compare the EU to other jurisdictions, the quality of liquidity elsewhere is actually more important than in the EU, and that has, at the end of the day, impacts on the returns of pensioners and savers. If I've got that right, yeah.
That's right.
Matty, and you were unmuting yourself. Did you want to come in?
No, just getting ready for the next
The next round. Okay. Susan was waving. So, Susan.
That was deliberate, the wave. No, I just wanted to come in to Pablo's, excellent sort of walking us through liquidity from the sell side perspective, and just to support what you said in terms of the recent AFME report on CMU and the different KPIs and metrics you have to measure liquidity. So very interesting to hear about your focus on mid-cap stocks and the worse spread story for the EU stocks as compared to the US, with that being one measure, the spreads. And I just wanted to say that I've also looked at data sort of in the last year or so, speaking to the liquidity that we have in Europe compared to some of the other markets, some of the large capital markets. And the same story there, the trading volumes are simply lower, and the trends, and if the focus here was US and Asia, we saw, healthy growth in those markets in terms of trading volumes. And if you look at the EU, you actually had stagnant and in fact contracting contractions in terms of trading volumes, which would support what you've said in terms of these wider spreads that we find in the EU and the greater associated costs. So it's kind of a circular thing that's happening, that we need to be able to pinpoint how we ensure continued growth going forward.
Just quite a worrying picture that you all paint, especially in light of ongoing initiatives to build these capital markets. So maybe we come back to that. I'm going to get ready to ask the panelists a second round of questions, but before doing that, just again, a reminder to the audience, if you have any questions on anything that has been raised so far, please do pop the question in the Q&A box, and we'll ask the panelists to answer them. In the second round, I wanted to turn to the policy and regulatory frameworks. I just mentioned that there are many initiatives underway at European level under the CMU banner, the Capital Markets Union banner, and there have been for a number of years to try to develop the EU's capital markets capacity, one of the objectives there is to also have a solution for the EU's pensions challenge. Doesn't seem that much progress has concretely been made. But before sort of considering the broader CMU agenda and whether or not it's been a success and what might be done to sort of change the dial there, I'd like to ask each of you in turn what the current regulatory priorities and pressures are that you and your members are facing. What are the big issues for you for next year, for example? Matti, would you like to kick us off again?
Yep, thanks. Thanks, Jacqueline. I mean, there are many, it's a huge amount of regulation. We had our Danish member, Insurance and Pension Denmark, a couple of days ago, been very vocal about the excessive amount of regulation and whether anybody actually assesses whether it makes sense. And of the recent regulatory issues, we very much, as I'm sure everybody else is working on, sustainable finance issues, very, very important, but very complicated issues, and how they take into consideration the proportionality aspects, because pension fund landscape is very diverse. But so it's much is ongoing. But one particular issue that I would like to raise is the question that the pension funds have to start clearing the derivatives next year. This all comes from the European Market and Infrastructure Regulation, that was a result of the great financial crisis, that central clearing or clearing needs to be in place, and pension funds have been exempted from this clearing obligation, and this exemption has been extended a couple of times, but now it comes to an end. So on the 19th of June 2023, pension funds have to start clearing, and we've been discussing, like, what does this mean, because there can be, there's you have to post the variation margins, and then you can have margin calls, and looking at what happened in the UK in September, when the value of the price of the 30-year UK government bond suddenly fell, and then that increased tremendously margin calls and demanded more cash. So now when pension funds go into clearing, then in this present regulatory framework, they need to have cash as collateral then if and when these margin calls come. And then the question is, like, is the market able to provide this? It's a question of transforming high quality liquid bonds intraday, as it may be, into cash to post variation margins. And that is a concern that we have, that if there are drastic moves, real stress situations in the market, is this doable, or are there problems, and how could they be alleviated? In normal situation, it seems clear that there's no problem. And if we look at the European market, there's not that much derivatives at the moment. Most of them are, like 96%, are with the Dutch pension funds. So it's really at the moment really first and foremost a question of the Dutch pension funds. But it is a big question, and then it comes down whether the repo markets are liquid then in this kind of a situation. And we are not quite certain that would be the case, and we've been asking for the central bank then to provide to the central clearing entities then liquidity in this kind of a situation. So that is something that is topical for us. It's a regulatory issue. There is the equivalence with the UK still in place until 2025. Most of the pension fund clearing is still in the UK, in London. Europe is developing, of course, clearing, and hopefully that is successful, so that the pension funds have good opportunities and good choices with good outcomes. That's the interest that we have there, that they can meet the requirements and be, have efficient services for this. So that is really what's happening next year. But overall, I would say that the liquidity risk management is becoming more in the focus of both supervisors and maybe then regulators in the end. Maybe there will be more emphasis also in legislation, in regulation on these issues as part of risk management, how liquidity risks are managed. So I would anticipate that this would be something that is upcoming.
Absolutely, and thanks for that. And if I'm not mistaken, this, I mean, I think Susan, you also mentioned the recent stress in UK gilt markets. Of course, there was the dash for cash during the pandemic. These sort of episodes of stress are drawing the attention of supervisors. And I think that at international level, the FSB and the various bodies which are part of the international community are thinking very closely about this, and will be launching work, if not measures, to see what can be done to sort of manage and reduce spikes in the demand for liquidity in times of stress. And they, of course, are especially concerned about managing the financial stability impact. So liquidity is important in that sense as well. It's important for financial stability that it is available, accessible, and I suppose that it is paid for, and that market participants are prepared also.
Jackie,
Sure, Susan,
could I put a question to Matti
please go ahead.
about this interesting point around the expiry of the pensions exemption from clearing? I just wondered, to ease your concerns around collateral management, are you specifically asking for central bank access, and the ability to convert high quality sovereigns into cash? So would it be central bank access, or is it kind of more of a blanket, change in the rules from the CCP perspective, where they would admit different types of collateral? So at what level would that happen, do you think?
We have proposed to the Commission as a solution that the central clearing houses could provide central bank liquidity to pension funds in times of stress to convert high quality governments into cash. So that how exactly that could be done and whether there is any appetite by the central banks to do that, that's uncertain. We have no positive response, but we've been discussing this, and I think what happened in the UK was, made this more relevant, and because we've been talking about this a long time. This has been, 10 years discussion of when the clearing comes, what kind of collateral can you use? Do you have to convert that into cash? Pension funds, they cannot hold that amount of cash that would be needed. So we've tried different options, but this central bank, like, backing in the end, if the markets do not provide, because normal times, yes, pension funds are able to sell the high quality bonds, no problem, but we're not certain if something more drastic happens. We think that pension funds are not the first priority of the markets for everybody. So there are many others who are then, in search for liquidity. So what we have said, that we think that central banks could act in this way, and we hope that we would rather do this when we don't have a huge crisis, not during or after a huge crisis. But it remains to be seen whether there's any appetite for this.
Of course, central bank provision of liquidity and liquidity provision, the last as the last resort, also has costs and implications. So of course, it's not that straightforward. And I think, as Susan mentioned, there are a number of regulatory factors which also weigh on which weigh on liquidity providers in the markets, which can act as constraints. And so I do think that Matti is right, that this is an area that will be ripe for supervisory and regulatory attention over the months and years to come. But let's move on, perhaps away from the issues around the end of the exemption for pension funds, the clearing exemption for pension funds. And Susan, if I could turn to you to ask you about two regulatory priorities, which I'm pretty sure you are on your radar because they're important for both the trading and post-trading landscape. That's the MIFIA review and the CSDR refit. What do you see as being sort of risks and opportunities in these on these two files as negotiations carry on into 2023?
Yeah, so thanks, Jackie. On the MIFIR review, negotiations are quite advanced now. As you know, we've had the EC proposal now kicking around for over a year, and both Council and Parliament are looking at that text. I would say that at this point, as buy side and as participants who've been quite involved in the debate, for us, I think the key area of focus at this point is, can we create, and I'm focusing here on consolidated tape, not market structure, because both are sort of objectives of this review. But if I park market structure, on consolidated tape, I think we'd really like to create the conditions for consolidated tape providers to wish to enter the arena and to step up and to provide a commercially viable tape. And so that's kind of a concern when we examine the proposal that's on the table. And I think what are the features that we still need to nail down? We do have mandatory contribution towards the tape, which was, a kind of huge necessity and requirement without which we couldn't move forward. So we are going to have exchanges provide data towards the tape. So that's good. In terms of, having a tape that ultimately users will want to purchase and that has, a commercial use case around it, I think if we restrict ourselves to a post-trade only tape, so only showing data that's happened after a trade has been executed, I think is probably really limiting the appeal of this tape. So if we go for pre-trade, live stream data, ability to see best bid and offer, I think is much more attractive, and certainly my members and I would think the same for the AFME and also pension funds would make a much more compelling case. And maybe if I could also briefly to touch on something that sadly hasn't been the focus of this review, but again, looking at consolidated tape, I think it's a bit of a missed opportunity if we don't develop some thinking around the governance of the tape. So having a strong framework around what the governance looks like. And I say this because, for people who follow consolidated tape issues quite closely, we know that in the US, it's a major issue now, and it's one of the kind of areas of reform that's being looked at. So if we're given this chance to build from the ground up, personally, I think that, if we launch a tape in 2 years, 18 months, however long it takes, and we don't have the right governance, we run into trouble sort of in the medium to long term. And I think one of the issues, okay, I think are we running out of time, Jackie?
No. I was going to ask you,
Yeah.
what is good governance in this context then? What are the ingredients?
Exactly. So I think key principles that I think should be enshrined in governance of the tape is wide representation. That's, and again, in contrast to what we have in the US, the frustrations experienced by users of the tape in the US is you don't have that broad representation. So you only have the data providers. Of course, they should be represented, but it should not be an exclusive shop where it's only the exchanges running the tape. So if you have a broader representation where the user community is also represented, I think that's important. And they should have voting rights, so they have a say about how the tape is run, the technology layer of it, and also sort of on the pricing and how that's determined. So I think that's important. And then if I could maybe quickly still on the MIFIR, speaking of sort of opening up cans of worms, so definitely the governance is important, but also I think best execution framework. Without wishing to go into too much detail, I think with the availability of pre-trade data that consolidated tape would bring about, there is this move to can we make a straight read across have performing best execution and relying on the tape. And I think that's fine. It should be a supporting tool, the using what we hope is going to be high quality data off the tape, but it should not be a prescriptive approach, and it shouldn't be the only determinant, because in Europe we have a more holistic view on what constitutes best execution. Going back to Pablo's point, we don't have a single CSD and a single CCP. We have a number of them, and with different fees and different costs to execution. So all of that should be taken into account when we're looking to see how we got the best execution for the investor. Price off the tape should only be one factor. There should be others. Yeah, so maybe I stop there. If you want, I could talk about CSR refit, but I also think that perhaps Pablo wants to have a go. Yeah.
Yes, I'm sure Pablo does, but I'm going to ask Pablo to hold on also just 1 second, because we have a question from the audience, which I think was raised in the context of, I think it's probably a question that could be directed to Matti, but please feel free to come in, all of you. If I try and summarize it, I think the question is, who can replace banks, or what can replace banks in liquidity provision to the buy side? So where are the alternatives if banks aren't able to step in for whatever reason? And then the audience member is also asking whether you think European banks are as willing or able to provide liquidity as their Anglo-Saxon peers. If there are any takers on that.
Well, I can start having a go. I think banks have sort of taken up the role as committed market makers for a number of reasons. They have the sort of client relationships to intermediate. They have the balance sheet capacity to intermediate, especially when it comes to bond markets, where they play that really crucial role. So being a market maker requires commitment in terms of your relationship with clients, and the commitment to provide liquidity in all conditions, and particularly when markets are under stress and there's volatility. So I think, in that client relationship role, banks have, kind of perform that intermediation function that is very different to proprietary trading. So I think that needs to be underlined. And to the question, regulation does have an impact. So one aspect that we stress from the AFME perspective is to look at the interaction between prudential regulation that has made it, more difficult to hold large inventories of bonds on the balance sheet, and that this comes from the sort of global level Basel reforms. The interaction between that and markets regulation, where at the moment in the MiFIR debate, we're looking at the deferrals regime, which is crucial to allow the liquidity providers to hedge and unwind positions. So these pressures again come together and can really complicate the environment for banks to provide that service. So it's crucial to look at these interactions holistically.
Oh, absolutely. And I guess if I try to answer the question, who can replace banks in liquidity provision if they are not able to do so, I think that the only answer probably is the central banks. So that's what we were referring to earlier as liquidity provision of the last resort, but which comes with other challenges and issues, of course. Pablo, do you want to take a stab at whether there's any difference between European and American banks, or Anglo-Saxon banks, as the question was?
I think it comes down to the way different businesses have evolved, of course. But one factor to think about is also the development of the CMU, and it's fair to say the American banks have a large, deep home market to rely on, and we know that the picture is different in Europe. So that could be a factor in a way. Banks kind of have scaled up, globally, having that depth in their home market. So, from our perspective, this makes the case, always strong for the CMU. There are other differences. For example, one area AFME cares a lot about is securitization, which is an area where the US banks have a functioning home market again, and in Europe, it's been a priority of the CMU to restore the securitization market. And and we have fallen short of that at the moment. So that is another area where we think the American peers may have a competitive advantage as well.
And are there any other recommendations that that you would have to improve the efficiency of Europe's wholesale markets?
I think it comes down to the ecosystem in the four areas we've been talking about. So first of all, listings, because we do need more companies in the market. That generates more investment opportunities for pension funds and other investors, and more depth in the market. So the upcoming Listing Act is going to be a really important debate here. Then we need the trading ecosystem to work well. What we've been talking about in the MIFIR context and the consolidated tape. We at AFME are worried about some proposals that would restrict competition and choice in the equity market. So that's crucial that we avoid undue restrictions on the trading environment for investors. There are other aspects of MIFIR, of course. Then looking at settlement, we have the CSDR review underway. And I really hope we never have to impose mandatory buy-ins in the EU, because that would be a serious problem for liquidity and liquidity providers in a different market. So that regime is under discussion at the moment. And finally, clearing. I mean, Matti spoke about this. So I would say the four areas are all crucial to the ecosystem, and we need to get them in the right place.
And all of these things are being looked at sort of concurrently right now. So very important to indeed find the right balance to make sure that we have those efficient wholesale markets. We're coming close to the end of our time, so maybe to start wrapping up, I'd like to ask each of you in turn for your sort of wish. If you had sort of one wish on which kind of initiative, whether it's regulatory or other, which could be transformative in helping individuals meet their retirement goals in a European context, what would it be? Matti, let's start with you.
Thanks. We've been here talking about financial markets and efficient. The financial markets are, of course, important for funded pensions, but I would step a bit, clearly that's a vital issue, but stepping a bit away from that, that's not the real issue. The real issue is the design of the retirement systems, and that's a political decision. These are social issues. Like if we talk about ESG, we are a big part of the S. The retirement systems, pension systems, a big part of the social in Europe, and that is now, and it will be a political decision at member state level first and foremost. But what Europe can do is to push member states into the right direction, and it is clear that people in Europe will need increasingly more funded pensions, and of course those funds then need to be well managed and invested. But the first thing is to push member states into that direction, because otherwise it will not be sustainable, socially or fiscally sustainable. We are an aging continent. We need to, these generations need to save for themselves already, and Europe has tools for this. There is an ongoing discussion on the European economic governance model, the Stability and Growth Pact. What are the debt and deficit levels of member states? And these instruments can be powerful in pushing the politicians in member states into the direction where people will have better retirement outcomes as a consequence of having more funded pensions that are then invested efficiently also in the European markets.
Yeah. Thanks. So a lot is still in the importantly in the hands of member states to try to move things in the right direction. Of course, efficient markets are an important ingredient, but they're only one ingredient, and they're deeper, also more fundamental questions that need to be addressed. So thank you for that. So I'm not sure there was an easy solution, one easy single solution in what you said, but a very important point. Susan, what would your wish be?
So I think mine is going to be even loftier than what Matty said. So I'll hopefully make you look good, Matty. But since this is a wish list, I would say
one wish.
One wish. And, Jackie, I think we've covered a number of sort of pieces of legislation in discussion today. And I don't think even this sort of narrow basket of legislation would bring us to that goal. It's much broader than that. It's not just the CMU, there's other initiatives at EU level that are underway. But my wish would be to have a retail investor, a European retail investor that's better informed and more confident in engaging with capital markets, whether that's through direct trading or through, mutual funds. I think if we could achieve that, because I don't think we're there culturally. And as you say, there will be so many different ingredients to put into that. Some of them might have to do with MiFIR and reform or even CSDR in the right direction. But yeah, that would be my wish.
Thank you. That's very clear. And Pablo, the final word and wish is yours.
Thank you. Well, I think it's crucial to mobilize the deep pools of savings that we have in Europe into productive investments. And in the current environment, really keeping our savings in deposit accounts is a loss of value, a loss of to our future kind of well-being. So I think there's a cocktail of measures there, but it seems from what Matti said and for the various studies that reform at a national level is really crucial. And looking at taxation, for example, looking at the national frameworks that would enable citizens to invest confidently in the right products, I think that is going to be crucial. So we need to focus on that and financial education, as Susan said.
So education, awareness, incentives to channel savings so that pensions are funded, all of those things are critical ingredients. And of course, efficient markets have a role to play in supporting this, but they're only part of the ingredients. Ladies and gentlemen, thank you very much. Thank you to the panelists for sharing your views and dissecting this relatively complex topic with us. I hope that the audience found it interesting. I certainly did. Thanks for your time. Thank you to everybody for staying with us. We're a little bit over the hour. But if you want a refresher of the role that banks can play in supporting efficient wholesale markets and pension funds, please do visit the AFME website to take another look at our little video clip. And for those of you who are on a retirement week roll, do join the IFAMA webinar, which is kicking off shortly on the contribution of capital markets and asset managers to good outcomes for defined contribution pensions. Apologies. Thank you very much, everybody. Have a good afternoon and look forward to discussing these issues with you on a future occasion again. Thanks. Bye-bye.
Bye-bye.